Chapter 14 is on residential real estate finance. And let me start off by saying that there are two theories in finance. One is title theory and the other is lien theory. In a title theory state, when you borrow money from a bank, the bank takes temporary title of the property until the loan is repaid. In most states, including Florida, we use what is called a lien theory. In other words, when you borrow money from a bank, the bank doesn't get title to the property. You simply give them a collateral instrument called a mortgage, and they have the property as a hostage, so to speak, for the time of period that you're financing. With that said, let's talk about the promissory note and a mortgage. The promissory note is a legal acknowledgement of a debt. It is an IOU. It's all the details of the debt. The promissory note is not recorded. Therefore, the promissory note does not require witnesses. In fact, if you do witness a promissory note, there's a good chance that you're going to become liable for that note. Typically speaking, when you borrow money from a bank and you sign a note, the lender is also going to get you to sign a mortgage. Let's make sure we understand what a mortgage is. A mortgage is a collateral instrument. It's security. And the two parties to this, you've got the mortgagor and the mortgagee. Remember, ORs give and EEs receive. The mortgagor is the person giving the mortgage or giving the property as collateral. The EE is the party receiving the property as collateral. Therefore, the borrower is the mortgagor. The bank is the mortgagee. A good way to remember the difference between the two, you're giving your property to the bank as a hostage to the mortgage until the ransom note is repaid. And then once the ransom note's repaid, the bank's going to give you your hostage back through something we call a satisfaction of mortgage. A satisfaction of mortgage simply releases the property as collateral. So a mortgage is a collateral instrument. And let me say this. It's a conveyance instrument that will allow the bank that if you default on the note, it will allow the bank to take your property and sell it at a public auction to pay that note off. So really, if you really want to know what a mortgage is, you're giving the bank legal permission to sell your property in foreclosure. As far as some of the important mortgage provisions, a promise to repay, a promise to pay taxes and insurance, keep the property in good repair, and there's also a little clause in it that says that you're not supposed to remove the building. How about that? Some of the important clauses in a mortgage, one is a prepayment clause, and what that basically says is it will outline a borrower's right to either prepay or not prepay regarding penalties. In most cases, if a mortgage and note is silent, in other words, doesn't discuss prepayment and prepayment penalties, a borrower has the right to prepay without a penalty. The mortgage is going to have to be very specific if there's going to be a penalty. The acceleration clause is a clause that will accelerate the payments, call them all due in case there's a default. In fact, that's really the only way that you can foreclose. You can't foreclose on something that's not delinquent. So in order to foreclose on the entire debt, you've got to be able to accelerate it. The due on sale clause is a clause in a mortgage. It's also known as the alienation clause that says that if a property is sold and that the mortgage is still in place, has not been paid off, that the lender has to be notified and has to give permission. Failure to do so, you're in default. And what that's supposed to do is to prevent people from letting people assume loans that are not qualified. As far as the loan-to-value ratio, this is what a lot of banks look at. The loan-to-value ratio is the relationship between the value of the property and the loan or the amount that you're borrowing. So it's the loan over the value. Regarding discount points, a lot of your lenders charge discount points. Now let me explain that. A discount point is simply prepaid interest. And the way that it works is that if a lender charges you a discount point to borrow money, for every point they charge you, the way they calculate it and the way that you have to pay it at closing, 1 point equals 1% interest. The way that banks see it, though, is that they charge you discount points. it also, over the long haul, will up their yield in terms of the amount of money they're making. For every discount point that a lender charges, it's going to increase their yield by 1/8 of 1%. Regarding mortgage assignment, remember we said that most documents are assignable, most contracts are assignable. If a mortgage is sold into the secondary market, it's being assigned. In other words, if a bank decides to take their mortgage and note and sell it to Fannie Mae or Freddie Mac, they're basically assigning that mortgage and note. In order for that investor, Fannie Mae, Freddie Mac, whoever it might be, to verify that mortgage balance, they will ask for an estoppel certificate. And what they're going to do is they're going to ask and verify that bank balance from the borrower of the debt. Regarding methods of payment and methods of taking title to property, there's two ways that you can take title. One is subject to the mortgage. The other is assumption. 99 and 44, 100% of the time, you're going to take title if you're going to assume somebody else's loan through an assumption of. And with an assumption of, just remember that whoever that new buyer is, they're also going to have to sign a promissory note. And as a result, both the new owner and the previous owner are going to be legally responsible for whatever debt remains. In a rare occasion, you may see a subject to. The subject tos usually occur when we have a non-qualifying assumable loan, such as the old FHA and VA loans, where somebody could come in and buy a property, take over the payments, but never sign a promissory note. When that occurs, only the previous owner is legally responsible for the debt. Remember that a person is going to be legally responsible for debt unless novation occurs. Novation is a release of liability. Regarding default, if a borrower defaults on their promissory note, there's going to be a judicial process to take place. We call that foreclosure. Once the default has occurred and it goes beyond a certain amount of time, that lender is going to accelerate the debt. They're going to call the entire debt due and payable through the acceleration clause. At that point, the first legal step in foreclosure is filing a les pendens on public record. In other words, they're putting everybody on notice that a lawsuit is now pending. At some point, that property is going to be sold at the courthouse steps to the highest bidder. Until that public auction occurs, the property owner has what we call an equity of redemption, or a right to redeem themselves of that foreclosure. Now, what some people do is, instead of going through the foreclosure process, if they know they can't make it, if they know they can't handle it, what they'll simply do is turn the property over to the bank through something called a deed in lieu of foreclosure. And let me say this, that even though a bank may entertain that idea, if they take a property deed in lieu of foreclosure, they're also taking any other liens that may be on the property. So a lot of banks aren't real hot on taking back properties deed in lieu of foreclosure. To begin with, a lien theory state, the property remains with the mortgagor, who is the property owner. And remember that Florida is a lien theory state. Title theory, the bank takes title temporarily to the property. The mortgagor is the borrower. The mortgagee is the bank. Your note is the IOU, and remember that the promissory note is not recorded. The mortgage is a security instrument, it's collateral, and it is recorded, putting everybody on public notice that the property is being held as collateral for a debt. The loan-to-value ratio is the amount of money that it relates to the loan amount and the value. Now remember that the value is either based on the contract price or the appraised value, whichever is the lower of the two. Discount points are prepaid interest. It increases the lender's yield by 1/8% for every point that's charged. The assumption of a mortgage, the buyer signs a new note. In other words, both the new buyer and the old owner are still liable for the debt. The first legal step in the foreclosure process is the les pendens being filed on public record. The equity of redemption is the right that the property owner has to pay off the loan and to prevent foreclosure. The due on sale clause requires the seller to get permission to transfer title with any property that's mortgaged. And this is the end of this chapter's review.